Hi, I'm Scott Starratt with Starratt Wealth Management, a part of Canaccord Genuity Wealth Management. Today, we're very fortunate to have someone I've known for a number of years. He's been in the financial industry for over 20 years. And Andrew Milne is a fellow who spent time at, I have to look at his extensive list here to make sure I get it all right. Standard Life Investments, spent time at Raymond James, Credential Securities, and really his experience has been head of mutual fund research, head of portfolio services, vice president of national accounts, and his existing firm that he's with now, he's been at Picton Mahoney for the last, since 2012. So I guess this is your ninth year. Is that math right?
Yeah, it is. Yeah.
Ninth year. And educationally, he holds a Bachelor BA of Environmental and Economics from the University of Victoria. Environmental studies back then, that was cutting edge.
You know what it was? It was leading edge back then. A lot of the stuff that people are now seeing more in the news today is stuff that we were looking at back in the day, but it was everything to do with resources, the efficient use of resources, which of course is an economics side of things, but also how does that impact us as, people and creatures that are on this planet for the long term. So it served me really well through my entire career, Scott.
Yeah, awesome. So one of the things I want to kind of start with and chat about more today is, Picton and yourself, knowing you and talking over the proverbial beer when you could get together and do that. One of the things, that I know Picton has been cutting edge about has been this whole idea of the death of the 60-40 portfolio. The idea that, a standard portfolio is 60% equities and 40% fixed income or bonds. And I know we've talked about this and a lot, and I want to hear kind of why do you think that is? Why do you think it's dying or is dead now?
Yeah, what I love about this is I know that you feel the exact same way, right? I mean, as you said, you and I have known each other for a long time. And the way we got to know each other was by realizing that the traditional way that people were investing had its limitations. And what could you do to help all the people that you look after, I guess, improve their portfolio? Here at Picton, we call it focusing on the quality of returns and fortifying a portfolio is what we call it. But yeah, when you look at it, every investment has its drivers, right? In the investment world, you and I call them the variables that matter to an investment. If you take a look at the fixed income side of the portfolio, we're in a situation where you have extremely low interest rates. And so when you have low rates, if you see an increase in rates, obviously the impact to your fixed income side is going to be negative. You can clip the coupon, but coupons are ridiculously low at the moment. What bonds still do for clients is they offer diversification, which is great because you do want things in the portfolio that move in a different way. Equities still provide return. There's no doubt about that. But with equities come risk. And so when you take a look at the fixed income portfolio, you've got 60% of your assets in the equity side of the portfolio, but more than 90% of the portfolio is responsible for the volatility on the overall portfolio. And that can be bad because you want to have investors stay inside the portfolio, right? You and I both deal with people on a daily basis. We know what investor behavior is like. You're terrific with people and you want them to be able to see their portfolio doing well. And you want them to understand that when you do get moments of volatility, it's an opportunity to take advantage of that. But you don't want to be putting them through lots of unnecessary volatility. So yeah, at Picton, we've always been forward looking. I've been forward looking through my career. You've been forward looking through your career. So you sit there and you say, okay, if the portfolio that people have traditionally invested in has been cash, bonds, and equity, why? There's other things out there, right? There's private equity, there's long, short portfolios, there's commodities, there's all sorts of different things like real estate that people can put inside the portfolio. By having those different things inside the portfolio, they all respond differently at different times. And so they'll move up at one point when one is moving down. Again, that helps the overall portfolio get there in a smoother fashion. And it just makes that ride better for the overall client.
Right. Yeah. Would you say that when we talk about this 60/40, how many in the real world? This isn't what the academics say or what everybody's white paper says or anything like that. But in the real world, how many portfolios? Let me back up. So one of
Yeah,
the things about your role now at Picton, being a partner at Picton,
yeah,
is you are one of the conduits and the majority of the coordinator towards advisors and institutional clients and ultra high net worth family offices, that type of thing.
you got it.
So you get to see a lot of what's going on out there,
Yeah,
and although a lot of advisors are really good advisors, you get to see the good ones, the bad ones, the in between ones, you get to see it all,
yeah.
type of thing. So, when you look at that, how many people would you really say had a traditional 60/40 portfolio? Because you open up the Globe and Mail and it says it's dead and this, but is that really something that a lot of people had?
So I've been surprised a little bit. It's still at least 90% of retail investors would be locked into a traditional equity bond cash portfolio. It's getting better. You asked about the institutional side, so I can reflect on the institutional side and tell you about the transition there in a second, because I think that'll happen in the retail side as well. But uh, you're among a handful of advisors that have alternatives and something different than the 60/40 portfolio um, out there for their clients. It's a very, very small number. I don't have the exact number. I
No,
have
no, of
spoken
course.
with banking executives in the past who have let me know what they believe it to be from doing their run and things like that. And it's tiny. Now, a big part of that reason has been the 60/40 portfolio has done very well, right? I mean, you and I both know the equity side has done well. As rates were coming down, that bond side has done well. There hasn't been a reason to move unless you were prescient, unless you were looking through the windscreen like you were and saying, okay, what lies ahead of me, not what lies behind me. Recently, we've had poke with the stick in the markets. And so a lot more people are having to say, I need to look at other things inside my portfolio. So it will grow. If you want me to reflect on the institutional side, I can tell you about that. Um,
Yeah.
10, 15 years ago on the institutional side, I would say it was where the retail side is now very, very low as far as the number of institutions that were using any sort of other investments inside their portfolio. And that has changed. So some of the bigger institutions moved. You saw things like Yale. Everybody's familiar with the Yale endowment model in our business, the Harvard model as well. CalPERS, the California Public Employees Pension down in California. They were some big ones that moved, and that kind of forced everybody on the institutional side to pay attention to it. And as they started to see what they were achieving, especially with the lower risk and lower volatility, then you started to see more of the institutions migrate there as well. And I believe that your colleagues will follow along behind you for the same reason.
Yeah. So really, you've seen quite a. I guess you're busier than ever.
Yeah.
As
Oh,
far as both from an education standpoint and obviously from a talking about Picton to other advisors or other end clients point of view.
yeah. Yeah. So busiest year ever last year, and definitely busy just now. It was picking up without that poke, which is good.
Yeah.
That's a credit to how well investments other than equities and bonds have done.
Yeah.
But it has definitely ramped up considerably now.
Yeah. So want to just to shift things a little bit. So one of the things that you and I have talked about in the past is that this idea that the hedge fund, which is a horrible name. Like a
Yeah.
hedge fund is because most people that know hedge funds know it from the media
Yeah.
of people in the U.S. and some in Canada that make 100% returns in a year. That they aren't hedging. Like, let's be honest, right? They're taking big gambles or big bets, and oftentimes using leverage
Yeah.
in order to do that. So I'll use the word hedge fund in quotes, but that world has changed a lot. I mean, I think we've both seen a change, and you've kind of been in the ground floor in that with Picton. But
Yeah.
where do you see it going? And this is more Andrew's opinion of where you see it going, in the future from talking to, like I said, the people that you deal with.
Yeah, so you're extremely right. When I take a look at what people thought I did um, when I first got into the hedge industry, you're exactly right. I mean, people thought all the things that you were saying, and that's because there is definitely a bifurcation in the hedge fund world. So you and I at the moment, while we're doing this, we're sitting in Alberta. We're fortunate enough to know what hedging is because of the agricultural background inside our province, right? The whole idea of hedge is to take risk away. Um, and that's what we try to do. Instead of using leverage, as you mentioned, because one of the attractive sides of hedging is that you have the ability to take a dollar, turn it into $1, $2, $3, $4, $8, and put that into the idea that you like. That's not putting protection on the portfolio. That, as you mentioned, is trying to zip ahead and make more money. We use the leverage inside a portfolio to protect the overall portfolio. So that's one difference I would say, is that people are becoming much more familiar with what true authentic hedging is compared to leverage investing. The other one that I would say that I've been really pleased with, especially for individual clients, is that the regulators have become much more aware of what it is that we're doing inside portfolios. So what I mean by that is typically any type of hedged investment was only permitted for what we call in our industry accredited investors. And usually accredited investors comes down to how much money do you have in your pocket or how much money you're making, right? Which is a really bad measure of people's investment.
Yeah, because usually it's the people that, could least afford to lose money that should be using these hedging techniques. And yet they've restricted it to people that already have a lot of money. Not that people that already have a lot of money don't want to lose it, but you know what I mean? There's a lot of people that really can't afford. I mean, it means whether they stay in one location or not in their later years, they really can't afford to do it. So
yeah, and that's what's been terrific is Canada was a little bit slower than some of the other countries like the UK, the US, and Asia and things like that.
Yeah.
But it was terrific stuff because they did take the time to get to know exactly what's going on inside the space. And instead of restricting it to just the accredited investors, a few years ago, they said, you know what? These are investments that we believe within these guidelines are suitable for all Canadians. And that's been really terrific because, as you mentioned, what that's done is for people that want a bit more protection inside their portfolio, they can now access these type of investments, just your everyday average type of person. So that's probably been the biggest difference I've seen, especially in the Canadian market, has been opening this up to other investors. Where do I see it continuing to go now? What you'll see now is you'll see more and more big names get into it. So in my career, I've seen some very large names get into it through the years, which is absolutely terrific. I think those big names lend credibility to the area because when it's just the smaller boutiques and stuff like that, we don't always have the firepower to communicate what a great investment it is. When people see other institutions step in, they realize, okay, this is something that I should look at as well. So you'll see more institutions get into it, bigger ones as we go along. And then I think you'll just see it end up in more people's portfolios. Right now, the way it's set up is people think of cash, stocks, bonds, and then this space called alternatives. And alternatives is such a big area that people think it's just one asset class.
Oh, and it drives me crazy.
Doesn't it?
Because, if you're an equity manager, so you're buying and selling stocks, and that's your expertise.
Yeah.
And you just happen to have a larger toolbox. You're able to short or you're able to use leverage or whatever. You just have a bigger toolbox. Yet you're lumped in this completely separate category. But the reality is you're an equity manager. That's the asset class. The asset class is equities. You aren't going to buy, the Wayne Gretzky rookie card. some of the other things that have really become more popular in sports memorabilia and stuff. You're still managing equities.
Well, and it's wonderful as well when you can be a long short manager. When you take a look at it, you mentioned the things I've done in my career. I worked as an analyst in my career. When you can be following something and it's doing extremely well, and you decide that it's something that should be inside the portfolio, but then it hits the top of the bell and it starts to look like something you don't want to hold anymore. Typically, what can happen if you're a long only manager is that file gets set off to the side, and then you come back to that investment another time when it's doing well. If you're a long short manager, you can follow that investment through its entire life cycle,
Right.
because it might be a good one to hold when it's doing well, and it might be a good one to short and protect the portfolio with when it's not doing well. You can keep up with who the management is, how the management's change and stuff like that. So you can get to be much more intimate with the holding, just because you get to see it through that longer period of time. So yeah, that I think the more that it gets into people's portfolios and isn't considered something niche or something different, that is going to be a wonderful time for the retail investor. It's already there for the institutions, but it'll be great for the retail investor too.
So is the talent there? And what I mean by that is, if you have a manager that has, a long career, 30 years, and their performance numbers have been excellent, they're really, really good portfolio manager.
Yep.
But now you're asking that individual to short stocks or to use some other techniques that they maybe haven't used in their careers, right? One, it's probably not fair for them, but are you at all concerned that, that some firms, some companies might be tempted to get into this space with a bigger toolbox and not be able to actually know how to use the tools?
So, I mean, that has happened. So absolutely, it's an entirely different mentality owning a stock and having it go up compared to putting a short on the stock, for example, and then knowing when to hold that short and when to remove that short. So let me just come to that one kind of in two ways, because you reminded me about something else that I like in the industry. So what I like in the industry is there's tremendous talent that is coming in, and it's evolving too, right? So when I take a look at our shop, for example, that whole focus that I told you about at the beginning about the quality of returns, it's really now like what you do with your individual portfolios. When you're looking at your individual portfolio, I love what you do, because you're sitting there and you're saying, okay, it's not about just what investment do I hold, it's what risk comes along with that investment, right? And so I'm holding some equity here, but what is the specific risk in that equity? I'm holding some bonds over here. What's the specific risk in that bond, for example? And sometimes when you open up those investments, you can find that you've got more of the same risk in the different sides of your portfolio that you didn't realize were there. So there's tremendous talent now in the business, people like you that are looking at the overall portfolios, and they're sitting there and they're saying, okay, I want to build a really good quality portfolio, both from a return standpoint, a risk standpoint, a diversification standpoint, a correlation standpoint. So yeah, that does come back to your question about will there be more entrants and will they have the talent? We are a firm that's been around for quite a while. Every firm makes mistakes. Every person makes mistakes as you go along. I have no doubt for sure that as other people enter, they're going to make mistakes and they're going to learn things too. I always say, I'm an older guy, that it's better to let people run other people's money and then see how they do until they establish a nice track record, as you do. One of the things you do so well is come in and kick the tires of the firm and see what's going on. What's your return? How did you achieve that return? Are the same people still involved? All those things that matter. Yeah, so I think that there will be more entrants. It is a different game, and people like you should look at the longer term track record and go with that first before they start to speculate on trying something new.
Yeah. Okay. Well, that sounds really good. Well, really, I just wanted to thank you for joining us here today. That was a good short, quick chat. But definitely, if for people out there who are watching, if you do know of anyone who might appreciate this type of service and due diligence that Starratt Wealth Management does, don't be afraid to reach out to us at www.starrattwealth.com. We're more than happy to grab a virtual cup of coffee, or hopefully a real cup of coffee soon, and be able to chat and find out what your goals are and what's important to you. So thanks again, Andrew, and we look forward to chatting with you very soon.
Thanks, Scott.